HiPhi. Have you ever wondered what happens when a high-end electric brand suddenly loses momentum? That's exactly what happened with HiPhi. Initially positioned as a futuristic luxury EV maker with prices that could exceed $100,000, HiPhi looked like the perfect answer to premium brands. But here's the part most people overlook: luxury vehicles require enormous investment and scale to survive. When costs stay high and demand slows down, even premium buyers start questioning their purchase. Imagine you bought one of these expensive EVs, and then the company stopped building cars. What happens next? Who honors the warranty? Where do you get parts? When updates stop, your once cutting-edge vehicle suddenly starts looking like a risky long-term investment. This isn't just about technology, it's about financial endurance. As HiPhi's production slowed and supplier confidence weakened, the company faced restructuring. If you own or were planning to buy one of these, you need to understand that high price doesn't guarantee high stability. Remember this as we go forward: premium price tags can hide fragile financial foundations. WM Motor, a brand that actually delivered tens of thousands of vehicles before collapsing. This isn't a prototype story. It's the kind of real-world case you'll want to pay attention to if you're thinking about owning a Chinese EV long-term. WM Motor didn't just have flashy concepts, it had real customers driving real cars. Over 80,000 EVs were sold. But delivering cars isn't the same as sustaining a business. When WM Motor's bid to secure long-term funding fell through, the financial pressure became critical. Salaries were delayed, production slowed, and bankruptcy followed. Now ask yourself this: if a brand you bought from goes bankrupt, what happens to your vehicle over the next 5 years? Will service centers stay open? Will batteries and electronics still be supported? These questions matter, because the value of every EV you consider buying hinges on the brand's longevity. This example shows you something important: real delivery doesn't protect a brand from collapse. Aiways. Aiways tried something bold. It brought its electric SUV into Europe, Germany, France, and other major EV markets. If you're watching from Europe or the UK, this part hits close to home. But here's the twist most people miss: expansion costs money, sometimes more than it earns. Operating in Europe requires compliance with strict safety and emission standards, logistics networks, and after-sales service systems that cost millions to maintain. As financial pressures mounted, Aiways' European ambitions stalled. Dealerships closed, future deliveries slowed, and uncertainty spiked. Now imagine owning an EV in Europe with shrinking support, fewer service centers, limited parts supply, and potential warranty complications. If you plan long-term vehicle ownership, this scenario should make you pause. Expansion alone doesn't equal stability. It often magnifies financial risk if profitability isn't already secured. And this narrative gets even more interesting when we compare it to brands that never left China. Byton. Byton was once everywhere in EV headlines. Massive dashboard screens, sleek concept vehicles, Silicon Valley-style buzz, it had the look and the hype. But here's a fact you need to understand. Hype does not equal production. Byton amassed huge interest and even raised significant funding, but never achieved sustainable mass production. Factory plans were delayed. Investors became cautious. And ultimately, the company filed for bankruptcy. This is a classic case of the EV bubble's early casualties: startups that looked exciting but couldn't deliver. When capital was flowing freely, investors bet big on ideas. As the market matured and funding tightened, that approach failed. Here's a critical takeaway for you: when evaluating EV brands, always ask, can this company actually deliver and support cars for the next decade? Because if they can't, they're not just risky, they could leave you with a vehicle that quickly loses value. Faraday Future. Faraday Future isn't just another China-linked EV brand, it's a global narrative brand. It promised cutting-edge technology, luxury performance, and competition with the most elite EV makers. But ambition alone doesn't pay the bills. Production timelines were repeatedly delayed. Leadership uncertainty became public. Even when a limited number of vehicles were delivered, scale was nowhere near enough to support long-term viability. What does this tell you? It tells you that even with innovation and international visibility, execution still determines whether a brand survives. In the EV world, early hype can get headlines, but consistent execution is what keeps vehicles supported for years. If you're considering buying an EV from a new or struggling company, think, does this brand have the infrastructure to support me for the next decade, not just this year? Because if they don't, your vehicle could become a financial burden over time. NAO. Now let's talk about NAO, and this part is crucial because it's one brand that divides opinion heavily in premium markets. NAO is still operational. It keeps delivering cars. It's opened showrooms in Europe. It has battery swap stations and sub-brands that look exciting. But here's why you need to think deeper. NAO has been operating at a high cash burn rate, meaning it's spending significantly more than it earns as it scales. This strategy can work, if profitability eventually catches up with growth. But if it doesn't, financial pressure increases. Here's a question to consider. Would you feel confident buying a $60,000 EV from a company losing money every quarter, yet projecting future profitability? That's exactly the scenario with NAO. They are innovating and expanding, yes, but expansion costs money, and heavy financial losses can catch up faster than most people expect. This isn't about fear, it's about informed decision-making. You deserve to know not just how good the cars feel, but how likely the company is to support them years down the line.